22,300 is where the hourly averages come in as well. But first rates, right? The Nifty starting at about 22,376. That's the first tick in line with what the pre-open indicated, about 60, 70 points lower. There you go, 77, 79 points lower. The Sensex is down 260 points, 73,646. Bank Nifty starts about 1/3% lower. We are 150 points down. Yesterday, of course, the Nifty Bank consolidated for most of the session, 47,400. You got the mid-cap index, which is starting about 1/3 lower as well. Mid-caps and small caps last 2 days, sharp outperformance compared to large caps is what we have seen. But, well, these are indices. Sonia's got rates as far as stocks are concerned. Sonia.
Well, thanks a lot for that. I'm going to take it straight to stocks. So let's take the ones that are in the news first up, right? You have JSW Energy that will be raising about 5,000 crores through the QIP route. The street likes that, and hence the stock is outperforming the market as we speak. Ultratech Cement, we've talked about that ad nauseum. There's a capacity expansion plan. There are 2 new greenfield units that have been commissioned. Ultratech Cement is one of the big gainers this morning, up almost 2% in a market that is falling. Zee Entertainment has come out with some cost rationalization measures, and the street likes that. The MD and CEO Puneet Goenka has taken a 20% pay cut, and that's something that the stock is reacting to as well. MOIL, it's been a record year of production and sales for them in FY24. Look at the move there in MOIL, 5.5% higher. Volumes are also picking up there. Now, Asian Paints is something that has, perplexed a lot of investors because of its underperformance. And this morning, HSBC has cut their target price to 37.50 from 4,020, which is still well above the current market price. But there are a lot of people who are now waking up to the fact that there is severe competition in the system. HSBC talks about imminent pricing disruption in the paint sector, prospects of margin erosion as well. So Asian Paints is reacting to that, now down about 1%. Let's move to some of the IT names, because this is a very interesting space. Now, CLSA has gone ahead and upgraded 3 IT stocks. They've upgraded Tech Mahindra to a buy from an outperform. They've upgraded TCS and HCL Tech to an underperform from a sell. And they talk about how players like TCS are big beneficiaries of the recovery that we're seeing in demand, especially from some of their orders like BSNL, etc. So these are the couple of stocks that they like. So these are stocks that are in the news this morning. Otherwise, for the market, Prashant and Nigel, it's not so bad. I mean, yes, it is down about 90 odd points. But after the initial gap down, we're sort of holding on to the 22,300 level. Would be interesting to see how the rest of the day plays out. Do the dips get bought? Time will tell.
Well, that's right, Sonia. Thanks a lot for that. Well, just keep an eye on a few stocks. Bharat Forge actually is down close to around 2.5% odd. The March North America order slip for the 4th straight month. They're down to close to 33% on a month-on-month basis. So that's one of the big losers, actually. You have Ashok Leyland as well. That's pulled back close to around 2%. Godrej Consumers down close to around 2% in trade today. What's doing well? Well, Nalco is up and about, post that operational update. So that stock is doing quite well. Vedanta has valuation support as well. We had highlighted this at around 250, 260 rupees. That if Mr. Anil Agarwal can get his house in order, well, valuations will support them. And with the global trends, well, that's what would support them as well. So that stock is up close to around 1.5%. From the broader markets, a few more notable movers. Jai Prakash Power, well, that stock is up close to 4%. It's one of the top volume traded stocks. GMR Power as well is up close to around 3% as we speak. One of the top volume buzzers out there as well. On the losing end, Suzlon is down close to 100%. The stock had bounced up from around 36 rupees to around 42 rupees. But today, it's come in for some profit taking. Prashant.
Well, you've got a few more names, right, which perhaps deserve a mention. And I'll start with what's up. Market breadth, by the way, it's too early, but 1,100 higher and about 920 lower. So it's pretty close. On the upside, Cochin Shipyard is up 3.5%. It's got large volumes. Commodity strength has been something we've been pointing out. I spotted ONGC, which was slightly higher. It's a down market, so green stands out. MOIL is another one, which is up 5.5%. MOIL, by the way, has been an outperformer for the last 4-5 days now. Gensol is up 4.5%. I think they have reported numbers just a while back, 945. We've got Sadbhav Engineering, which is up about 5%. Volumes, I think, are very low. At least they're not picking up very, in a rapid fashion right at the outside. Irida is up about 3.5% as well. So these are the top volume-led gainers. As you can see, it's a fairly short list right now. On the downside, apart from what Nigel has already mentioned, Ramco Cements is down about 1.5%. And AU Bank is down about 1.25%. Lodha, I think got mentioned earlier, 3% lower on Lodha. And it's got decent-sized volumes as well. DLF is down about 1% as well to start the day with. So, I mean, it's a lower start as expected, but we've got a full session in front of us.
Just want to correct myself on Ashok Leyland. It's gone ex-dividend actually. So that explains why the stock is down close to around 1.5% odd. 4 rupees 95 paise. So that's effectively X of that. Actually, the stock is higher. So that's the reason why, in fact, that stock is lower. And also the cement stocks, as we pointed out, in late trade yesterday, the street was bidding up these stocks in anticipation of the price increase. Now they're coming to terms that maybe there'll be a price push, but we'll need to see how much of that is accepted. So that's going to be important to track for the next week or so.
I just want to mention one thing. Divi's Labs that, Nimesh was talking about the double upgrade that has come in. Divi's Labs is now up almost about 1% and you also have the entire IT pack which is seeing buying interest. So Tech Mahindra is one of your top gainers after CLSA is upgraded. Would be interesting to see if, these IT stocks come back in a big way considering the fall that these stocks have seen.
Absolutely. Well, we'll find out. Sunil Kaul is with us now. Let's put some questions to him about the markets. APAC equity strategist with Goldman Sachs. Sunil, great to have you with us here. Thank you very much for your time. So just wanted to get a first sense about you about what foreigners are doing, because you'd have interactions with large global funds, emerging market funds, etc. At the margin, one has been, and it's now found its way into mainstream press. There was an article yesterday saying that many emerging market investors are starting to unwind the long India, sell China trade, tactical, etc. But it quoted some very large fund managers with large AUMs. Is that something you're noticing? I must say, the reason, of course, which was cited by most of them was valuations, the big valuation differential, and also kind of pointed out that it's largely tactical. But is that happening, Sunil?
First of all, Prashant, pleasure to be back. Look, some of it is happening. As you said, the primary concern around India in terms of clients has been around valuations. Although I would say our core view is still positive on India. We still think that the fact that fundamentals are strong, earnings are coming through, that should offset some of the concerns around valuation. So we still like the market. On your question about India versus China, the market, if you look at the Chinese equity market, the market actually has rallied around 15% or so from the bottom, right? So the China rally is already kind of taking place. And on the margin, we actually have seen some investors kind of getting into that. But as you said, I think a lot of the investors we speak to who have sort of got into the China trade are largely either hedge funds or quant managers, not a lot of the long onlys in there. So I would say that also explains that on the margin, people are kind of viewing it as a tactical trade, and there are some people doing it. But our sense is that if you look at the broader pool of money, including some of the global funds, which are much more bigger than the Asian and the emerging market money, they're still sort of underweight India. And because of the stronger fundamental story, you can still see allocations improving in India over the next course of next 12 months.
Okay, allocations could improve in India over the course of the next 12 months. By the way, it's not a bad market at all. Just look at that. The Nifty is barely down about 0.3%. The mid-cap index actually is down just 0.2%. So given the kind of global volatility, this is a very, very resilient market that we have on our hand. Sunil, hi, good morning. I want to talk a little more about the broader, perspective on the market. But before that, we were just mentioning how CLSA has sort of upgraded the IT space now. And I noticed in your own report that you have also raised your stance on the IT sector to neutral. I want to understand, is that because valuations are looking attractive now? Or do you think the worst of, cut down in client spends, lower demand, etc., is out of the way? What's your rationale there?
Yeah, sorry, I think that's a great question. I think it's the latter. So we do think that numbers bottomed out in the December quarter. So I think the March quarter numbers in the 1Q reporting season, which will just start, I think the numbers may still be a tad softer, obviously given the guidance from Accenture as well. But we think March will be better than December already. And going into the second half of the year, we think numbers will start to improve much more materially. Bear in mind, as I have spoken before, we also have a much more constructive on the US economy as a whole. So we don't obviously have a recession as our forecast, and seems like market is coming to that view as well. So overall, our sense is that, IT is a sector which has obviously underperformed quite a bit if you look at the last 2 years in general, and the numbers have been cut as a lot. And so our sense is that things have sort of bottomed out here, so you could see better performance from the sector as a kind of a catch-up laggard as well.
All right. Hi, Sunil. Good morning and good to see you. When central banks are going to be in focus for this year, what are you all penciling in terms of Fed action? Since you're saying that the US economy could be stronger than anticipated, so what kind of rate cuts are you all penciling in from the Fed? And what about the RBI? How many rate cuts do we get out here?
Yeah, look, Nigel, I think we still are in the June cut camp. I think that the Fed rate cut cycle starts in June. I think having said that, so we're kind of penciling in 3 rate cuts this year. Having said that, I think that's one risk we are sort of closely monitoring, because kind of we came into the year thinking that you'll have 6 to 7 cuts. Now that's already sort of down to 3 cuts. I think market is kind of also pricing in 3, although there is a active debate whether that sort of gets to sort of 2 cuts, depending on how the US data pans out. So I think that's one thing we're kind of closely monitoring. But as a base case, I would say we do think sort of Fed goes in June. We do think that we have around 3 rate cuts this year, another sort of 3 rate cuts next year over the course of the next 12 months. So we see kind of central bank cutting across the board in most parts of Asia as well, barring obviously Japan and some markets like Malaysia, but pretty much everywhere else across the board. So that should be positive for equity markets. For RBI in particular, I would say I think the key, obviously we expect them to stay on hold in the policy meeting later this week. Obviously they'll be probably sounding more optimistic on growth, commit the 4% inflation target eventually. But I think what's more from an RBI standpoint is what happens on the liquidity front. And barring the near-term policy meeting, our overall stance is that obviously liquidity was very tight in the system for the last 2 quarters or so. Things have already started to ease in the last month or so. So if you obviously look at both the interbank rate, but also the CD rates, they already started to ease off, right? So liquidity in the system is improving. Our own sense is that this quarter you will see liquidity easing much more, and eventually RBI starts cutting rates in third quarter of this calendar. But the rate cutting cycle, we think in RBI's case, will be much more shallow. We are kind of baking in only 50 basis point of rate cuts. So it goes from 6.5 to 6%. So not a huge cutting cycle, but I think what's more important, what the markets will like, is the fact that liquidity is already easing, and we think more of that will happen in this quarter as well.
Sunil, I know the broad view is that you think rotation into large caps will continue, right? As you get closer to elections, is what you write in your report. You also highlight 10 or 12 names in the mid and small cap space where you think there is a fair bit of crowding in which has happened. But let me ask you on the other side. I mean, it's a large and now deep investable market in that sense. Deeper, it's all relative, of course. So highlight some names for us, where you're still finding opportunities in that space, in the down the curve, market cap curve, which you've put out, where you've coverage and which you like. Yeah.
Yeah, look, I'll answer it 2 ways, Prashant, without getting into single names. I think one is that if you look at the broader market, I would say the theme of alpha still continues to play out in India, right? I think the first quarter we just went by is a good reminder of that, right? If you just looked at the mid and small caps obviously have corrected only 5 to 10%. If you look at Nifty, it's only up 3% or so. Probably MSCI India is up 7%. But if you look beneath the surface, right? I mean, there is a huge sort of a wide sort of dispersion between sectors, between stocks. I mean, just to give 1 or 2 examples, if you look at the consumer pack, right, you have discretionary outperforming staples by more than 20 percentage points in the last 3 months, right? If you look at, for example, commodity space, you have energy outstripping metals and mining and materials by 20 percentage points. So if you look at beneath the stocks, even in MSCI India, which is not just large cap, it's basically large cap plus mid cap, you have 40% of the stocks which have given double-digit returns. You have 30% of the stocks that are down for the year. So there's a huge sort of dispersion within the market which is already underway, on top of the entire rotations which you just mentioned, right? So we think the environment continues to be like that. Now, in the sort of value pockets, the way you asked the question, I would say there are still sort of themes we like within the market, and the way we kind of pick up the stocks is kind of where fundamentals are strong. These are buy-rated companies which our analysts like, and then they also kind of belong to one of the themes we have. So, for example, some of the themes we have been mentioning in our reports is this. You mentioned the rotation into large caps and the quality large cap names, but sort of beyond those large caps, there's also the theme of kind of high-end consumption, affluent India, as we call it. There is a theme of Make in India. There is a defense theme going on. We also are very bullish on the real estate cycle, and we think the best way to play that is through the building material or the late cycle construction materials. So if you go through these themes, I think there are enough themes within the market which investors can play. And then when you sort of look at the stocks, we sort of go with the analyst picks where we have the most conviction on.
Okay. I wanted your thoughts. I mean, I do notice that in some of the names that you own, right, some of the names that you've mentioned, whether it's RVNL, whether it's IRCON, something like a JBM Auto, these are in spaces that have grown very fast over the last couple of years, whether it's railways or EVs, etc. But you mentioned that now it's become a bit of a crowded trade, as well as valuations are expensive. So what do you do in these pockets? Do you sort of churn out? Do you continue to keep the faith here? What's your stance?
Yeah, look, I think within the mid cap, I would say, I mean, obviously the headline index is only 5 to 10% down, right? But that's, I think, masking the broader sort of deeper correction that has happened within these indices, right? So one of the things we also highlighted in the report is that if you looked at the sort of mid cap 150 stocks and the small cap 250, which is basically the 400 stocks beyond the top 100 names. So within those 400 stocks, more than half of them, so more than 200 stocks have actually corrected double digit already, right? And there are some stocks that have corrected 35 to 40%, right? So there is some deeper correction that has happened in the pocket. And so obviously some of these stocks, as I mentioned, that still belong to some of the themes we like selectively. We do like those stocks. The stocks which we think are under risk, as you pointed out, are the ones where we think despite the recent correction, stocks are still more than 100% up in the last 1 year. So the price move has been very extreme. B, your valuations are running more than 2 standard deviations. So it's kind of harder to justify that things are, even the numbers are not in the price. And C, when you look at the top sort of domestic mutual funds, all of them are kind of owning the same stocks. These stocks also look pretty crowded. So that's one sort of pocket of the market, somewhat smaller, where we think it's worth kind of monitoring that risk, and probably there could be more downside there. But to your earlier question, if there are stocks that have already corrected, as I said, 30-40%, and we like them thematically, that's an area to build up exposure.
Okay, all right, Sunil, final question before we let you go. You know, the Chinese markets have bounced, but as you said at the start of this conversation, it's missing out on long-only funds, so that's important to note. But how do you play this entire commodity pullback that we're seeing? You know, metals move with momentum. Valuations, it's already, gone through the roof in comparison to, say, a 5-10-year average. But how are you all placed on Indian stocks, the metal-facing stocks?
Yeah, so we don't have sort of active coverage, unfortunately, Nigel, on the metal space, and so we kind of market weight that space. But I would say within the broader commodities sort of cohort, the way we are kind of placed within our allocation is that we like energy, so sort of refiners, obviously, and the index heavyweights there, which is not just energy view, but also kind of the telco plays and the inflection in capex and the free cash flows there. So we like some of the refiners and the index heavyweights in the energy space. We as I said, metals, we're kind of more neutral there. We do like, if you club utilities in the broader commodity spectrum, we do have an overweight on utilities, which is more a thesis around sort of peak power shortages happening and focus on renewables. So that's another way to play that. Where we are most cautious on within this sort of cohort is the oil marketing companies, where we think there is still pressure both on refining margins, but also on the marketing margins. And obviously these are kind of contra oil plays typically. We still think oil kind of is bouncing around at $80 on Brent. And there is sort of downside on the margins, and these stocks have rallied a lot. So we are kind of much more cautious there. So I would say, like utilities, like refiners, more neutral on metals, and cautious on OMCs.
Okay, well, thanks a lot for joining in, Sunil. Appreciate your time here. That's the word coming in on the markets and on individual stocks and sectors, what you can do ahead of the, the pre-elections rally, as well as the markets overall. But market, it could go either way, to be honest. For now, the market is sort of pulling back from the lows, but it's still down about 80 odd points. So it could be quite tricky the rest of the day. The one space that has been doing very well is real estate. Prestige Estates is the stock on our radar. It's up 217% in the last 1 year. The company has recently entered into a deal with the Abu Dhabi Investment Authority, which is ADIA, and Kotak AIF for 2,000 crore rupees via its subsidiaries. Now, with this deal and the money, they want to develop greenfield residential projects across various spaces, Bengaluru, Mumbai, Goa and NCR, and they are going, full throttle in the Mumbai region as well, as we know. Irfan Razak, the Chairman and Managing Director of Prestige Estates, joins us now to talk more about that. Mr. Razak, thanks for joining in. If you can tell us a little more about this fundraise, particularly with ADIA. Why did you go via the equity fundraise route and not more debt in the portfolio? And what is the plan that you have with the money in the residential space?
Good morning, Sonia. Yeah, I mean, we are quite thrilled to do this transaction because we always believe less reliance on debt and more on equity is the way to go. And of course, this is a quasi-debt. It's a blend of both. It's actually it's the first time that ADIA has directly invested into India, into any company, into real estate especially. And so that's a big one for us. This is, of course, along with in partnership with the Kotak AIF. I do hope this whole transaction, in the sense that, of course, the transaction has fructified. The only thing is, once we touch somebody's money, we definitely want to see that we give them good returns. And the projects that they have invested in, I'm sure they will do well. And what it has done for us is it's extended our bandwidth to do more work. And that's what is more important. And hence, we've got 4 large developments across the country, which they have invested in. And I'm sure all these 4 developments should do well and bring in plus for all stakeholders.
Can you tell us what exactly is the pipeline in terms of project additions? What are these large developments that you're talking about? Because I'm sure that a complete blueprint has been put in place, with both ADIA and Kotak AIF. So can you give us a little more details?
Yes, of course, because there is a large tract of land in Delhi, and then there is 200 odd acres in Goa, plus Mumbai. And then, of course, Bangalore also, there's a 22-acre plot. So all these, some are buy. Actually, Bangalore is a buy. Mumbai is a buy. And then again, in Delhi, it's a joint development where there's a large amount that has to be paid as a deposit. And of course, again, Goa is a buy. So these are the transactions that we'll be putting through. They all work in progress in the sense they've been tied up. It's not as though we are going into the market and looking for land. These projects have been tied up. They only need to get fructified. And this the money will provide the ammunition to close up these transactions.
4 of these, right, Mr. Razak? Morning. Congratulations, sir. Prashant here.
Morning, Prashant. How are you?
Very well, sir. So these are identified transactions, right? I mean, so ADIA knows what they're getting into. I mean, what the money is going to be used for upfront.
Yes, they definitely know. Without that, they wouldn't be playing blind. And they have done their due diligence. So that helps both the parties, ADIA, Kotak, as well as us, that there's some certainty. And we are only restless and, get ensure that these transactions complete, fructify, we get the plans done, get the approvals, and go to the market with a launch.
Okay. The money comes into subsidiaries, right? The platforms created for the purpose of execution of some of these transactions. What is the revenue attributable over how many years, and what will Prestige share be from these projects?
See, the overall revenue from these 4 projects should be around 18,000 plus crores. And as of now, since it's a structured transaction, we have an option at any point, if we have surpluses in these projects, to exit ADIA, the partners, at a certain given rate. So that's how it has been structured. But if they want to, they can go through to the end. So in fact, it suits us if we can do things quickly and have a good turnaround. We can exit them also. We've done that in the past with the HDFC fund. So I think the similar strategy we have in mind. And we are hoping that it all goes well. What it does is it will just give them confidence, give us confidence, and that will allow us to do and turn around more projects and gives us more ammunition for future.
But if they go till the end, let's just assume that they stay with you till the end, the execution of these projects, handover, etc. What in that case, what are the terms of the deal in terms of what's the revenue attributable to you?
Yeah, it's again, then it becomes the bottom line profits. They definitely will look at, but there's, as of now, what happens is, if you go to the end, it's whatever profit is there available is what is distributable on a 50-50 basis. But if it is not, then there's a certain return they look at, and we can return that money with that return.
What is that return, sir? Mr. Razak, hi, Nigel, welcome to the show. Could you tell us what is that targeted return that these investors will be looking at?
Yeah, they are, in this case, they are looking at 16%.
16%. All right. So we've got that number out of the way then. Let's focus on other aspects of the business. Well, you're expanding big time in NCR. I think you had mentioned that you targeted close to around 3,000 crores from the NCR region by FY26, if I remember correctly. Do you think you can surpass this number?
I think it's a very conservative number. I believe that it's very doable. We've just tied up a large tract of land in, Indrapuram extension in NCR, and that's been bought. And I believe that will give us big revenue. Apart from that, we've bought a land in Delhi as a KG Marg, and now this transaction, one more, which is again in Kamla Nagar in Delhi. This is where the ADIA money will go into. Now, these are the ones that will give us quite a lot of revenue, including our old transaction, which was held up for some time, which now will get the approval, which will see the light of day, is our Sector 150 in Noida. So all these put together, if things go well and the market, the way it's behaving, if we do things right, it'll get us more than that 3,000 crores. But then we have to do things right. And of course, the atmosphere should be good. Approval should come. That's the important one.
Okay, so you could surpass that 3,000 crores of sales in the NCR region as well by FY26, right? I mean, that was your target earlier. You also had a target of 25,000 crores of sales by the end of FY25 overall. Are you on track to do that? Do you think you can, surpass that as well?
We have just started FY25. The teams are working on it. They're pretty bullish, and they are quite sure that they should be able to do it. It's a guidance that you have picked up in some conversation of mine some time back, but I think it's very doable.
Okay, I have one more question overall on what's happening in the Mumbai market, since now you guys are, getting, full blown now in the Mumbai market. Do you think prices could fall from here on? Because there is so much supply coming up. Now connectivity has gone up. So, the Navi Mumbai area outside of Mumbai in the MMR region also is picking up in a big way. Do you reckon that because of these two issues, higher supply and better connectivity, perhaps prices in the premium luxury part of Mumbai could fall a bit in the near future?
It's an amazing question, Sonia, because I definitely would like connectivity to, since connectivity has become better. What it does is it helps people to get a home which they've always been dreaming of at a reasonable number, which is affordable. And that can happen only if we can move a little away from town, from central Mumbai. But now, if you're asking me the question that whether in central Mumbai, since so much supply is going to go down, I mean, it's not gone up that much that it can go down. But I believe it will sort of peak at some point of time, because luxury is something where people will not want to travel quite a distance to because they can afford to buy. So they are different target audience. So whoever has got that bandwidth will definitely stay in central Mumbai and definitely pay whatever that needs to be paid to get a home of their choice. So here it's about choice. And the other part is about a need. And the need is, if I need a home and I'm able to get a home between my budget, that's that 1.5, 2 crores or 2.5 crores, the more I move away a bit from town, yes, I will do that. And that's where even if we're looking for volumes in that region, we should look at those areas and make sure that we concentrate there. While, of course, while we are doing and catering to the niche market also, it's a balance of both. We definitely cannot do more and more of luxury, because the market is, as we all know, is not that large, and there's always a bandwidth for that.
Okay, all right, Mr. Razak, all the best, and thanks a lot for joining us and talking about the recent deal with Arya and Kotak AIF. Let's slip into a quick break. On the other side, J.N. Gupta, former executive director of SEBI, and Karan Taurani of Elara Securities will join in to put focus on the cost rationalization measures taken by Zee Entertainment after the deal with Sony collapsed. Stay tuned for more on that.
Welcome back. Well, the mid-cap index actually is the place that you need to be. The number of stocks advancing are close to around 2 stocks advancing for every 1 stock that's declining, and it's looking quite good as well. Advanced decline ratio should come up for you on the screen. But let's turn our attention to Zee Entertainment. The stock had opened up mildly in the green this after they have initiated some cost rationalization measures. The company's MD and CEO, Mr. Puneet Goenka, announced a decision to take a 20% voluntary reduction in his pay. To discuss this, well, we have Karan Taurani of Elara Securities who joins us, and the former ED of SEBI, Mr. J.N. Gupta, who joins us on the show. Good morning, gentlemen, and thanks so much for joining in. Well, Karan, let's get first, how do you approach the stock? You know, these measures were something that the management has been hinting about, but what's your view on the stock?
Hi, Nigel. Good morning. So I think these measures are very much in line. So if you remember the last quarter and after the deal fell through, the management did highlight that they want to really drive profitability. There is an intention here to drive EBITDA margins towards a guidance of about 18-20%. Currently, on a 9-month basis of FY24, the margins are very subdued at about 11%. So it's a long haul. A lot of effort will be needed in terms of execution, in terms of how these things pan out. But clearly, the intent is there, to improve profitability. And the stock could see the rating only based on execution and numbers and the financial performance. But of course, in terms of share price, one can't forget the fact that there's a lot of legal overhang on this company, and that will, kind of limit the upside from here on as well, because there are pending cases going on with NCLT. There are some issues going on with Disney as well, to that sports dishonoring of the contract. There could be some creditor issues as well, with NCLT, with the pending cases that were there. So multiple legal overhangs which are there, and that could probably limit the upside. But if the execution on numbers is right, and if the performance is consistent, you could see some re-rating in terms of the upgrades.
Okay, you spoke about growth, right? The potential of growth, Karan, but what do you think the growth could be in FY25, considering that, of course, there is this large overhang? So I'm sure it's going to have some impact on their business. And the other thing is streaming competition has intensified so much in the last 1 year, right? Do you think that could be a hindrance to growth for them?
So from a revenue growth standpoint, actually, there's not much here because the linear TV business is not growing more than about 3 to 4% on a steady state. And if you look at the digital segment, there is ample opportunity to grow at about 25-30%. But unfortunately, the contribution to business in terms of overall contribution of digital is about 10-odd%. So blended basis, they would not foresee growth rates of more than 6-odd%. The delta will come only basis margin improvement, because if you look at their EBITDA margins, historically they were at 24-25% in the pre-COVID times after Z5 losses. And currently they're at about 10-odd%. So if you look at the margin perspective, and if you see margin growth rate from here on, you will see better growth rate in terms of earnings. It could be 25% or 30% on this kind of a base. Secondly, in terms of competition, and we are seeing consolidation opportunities here. RI Disney coming together potentially, subject to the approvals going ahead. Competition definitely is going to increase from here on as we speak. And specifically on the digital side, Zee is more focused on regional, so they do have a cloud there. But I think Hindi GEC is a struggle here. They're not present into sports, thankfully, so their margins are somewhere kind of protected as compared to Star and Disney, when margins are very, very low because of losses that they make in sports. So somewhere there is respite in terms of what the portfolio is there right now. What is the kind of trajectory of margin improvement that we can see?
Gentlemen, morning. Karan and Mr. Gupta. Mr. Gupta, the story of Zee, I mean, Karan was talking about the nuts and bolts, right? The business itself. But here there are other issues, right? There is, of course, that deal which, of course, fell through. There is regulatory angle to it as well. So we don't know the final outcome of what SEBI's investigations are into the alleged siphoning of funds. Zee, of course, has maintained that all those transactions have always been genuine. So, but we don't know. We've not heard the final thing from SEBI. If you can comment on that for investors, those will be very, very critical. And if you have any thoughts on what has been announced yesterday, which is that pay cut. Go on, sir.
Very good morning to all of you. See, as I don't comment on a stock price or what is the future of a stock, I can talk about the governance and everything else. See, today, if you look at G is fighting battles at multiple fronts. Earlier, it was only the issues with SEBI and all other things, and originally it was Invesco versus G. Now it is a case that there are multiple litigation that is going on, a failed merger with Sony, problem with SEBI, then problem with Star, and everything. So at that time, this is all negative things have accumulated in G stock. And at this juncture, the most important thing is that not only fight the battle, but at least create a perception that you are doing everything good. So while I will not be able to comment what is going to happen in G versus SEBI or G versus Star or G versus Sony, I can say that they are taking a small step to say that, okay, we mean business and we are trying to do everything that is possible to regain our past glory. Whether they are successful or not, that is a time will tell. But as on this step of taking 20% cut in the salary is a very small step in creating a perception issue, or rather clearing the issue that yes, we want to move ahead and we are realizing the problems are there and that's all. What is going to happen, none of us will be able to say.
Karan, I want to come back to that point you made, which is very important, right, about the overall business. The linear TV business is not growing, barely 3 to 4%, as you pointed out, and they haven't been able to scale up the digital business because of several reasons. What then do you think will happen now that we have a big behemoth, media behemoth forming in the form of Reliance Disney? What is the incremental potential downside that you see to Zee's business now?
I think in terms of downside, there could be a correction in terms of growth rates, right? So these growth rates, what I'm talking about for linear TV, the industry is probably growing at about 4% on the linear TV side, and adding digital is about 6%. So let's say if RL and Disney gain market share on the linear TV side, which is they grow faster versus market, which potentially they can because of the synergies and because of the big cloud that they bring. You could see them gaining market share, and at that case, you could probably see Zee underperforming versus market averages, which means the growth rate of 4% becomes 2 to 3% on the linear TV side. On the digital side, there are concerns because clearly, on a distribution standpoint, Jio is going to become very strong here because of RR Disney coming together. They have very strong clout in terms of distribution. And that will limit the scale in terms of Z5. Or even if, let's say, Z5 grows at 25-30% on this kind of a base, the losses may not come down very sharply because these platforms will have to invest into content. And that's what we've said earlier as well, that, once you have a large business, once you have a large digital business commanding more than 40% of market on the OTT side, these smaller players are going to find it tough to raise ARPUs, are going to find it tough to reduce ARPUs. To reduce the losses rather. So I think these are potential threats that one can see as far as Zee is concerned.
Okay, Karan and Mr. Gupta, thank you so much for joining us and appreciate your time here on CNBC-TV18. Well, let's shift focus now to Greenpla Industries. The company has commenced manufacturing and commercial production of its functional furniture hardware. Manoj Tulsian, who's the Joint Managing Director and CEO of Greenpla Industries, joins us now to talk about that. Mr. Tulsian, good morning and thanks a lot for joining in. If you can just tell me a little bit about this JV, right? What is the investment that you've made? What is the current capacity of the plant and what is the kind of revenue potential that you're looking at?
Good morning, Sonia, and thank you for having me on the show. First thing first, I think, we congratulated our team because this entire commissioning of this plant took place in a real fast time of just 5 months. So the groundbreaking started in November, and in March, here we are with the commissioning of the line also. In terms of the JV structure, it's a 50-50 JV structure. There is a Turkish partner who holds 50%, Samet, and we hold 50% in this. The board is equally managed. And these Turkish players actually brings in their engineering expertise, and we will bring in our expertise of sales and distribution here. In terms of the total investment, it will happen over 3 phases. Over 3 phases, we'll be closely investing around 250 odd crores between the two partners, and which will have like a 30-70 equity to debt. So at our end, we would be investing around 40 crores of equity in this, and the equal amount will come from our JV partner.
Okay.
And the third phase, I think, will depend on the ramp up of the whole business. But our first target is to complete the entire phase in the next 3 years.
So this functional furniture hardware, right? Can you tell us a little bit about what the opportunity size is here? How big is the market? What kind of growth are you looking at? And generally, how are the margins for this kind of business?
So Sonia, this business again is the high end of the furniture hardware, in terms of the hinges, the slides, the upper mounts. And this business in India will compete to the Hettich and Hafele of the world. Okay, so it's a high EBITDA margin business. The industry size today, the way we look at, is almost around $2 billion. And, it actually today is very similar to the plywood business in terms of the organized and the unorganized share. I think the organized share today is around 20-25%. But the way the upscale is happening on the real estate, in terms of home building, in terms of the customer demand, we feel that this percentage is only going to go up. People are more and more savvy to use good and high engineered products. And this business, we assume that on a full scale can throw a EBITDA margin of anything above 25%.
That's a sort of very good margin that you're talking about. An opportunity size, I mean, the market size is $2 billion, right? Already.
Yes.
These products can be sold through your existing distribution because you got to get this out there as well, right? Or you'll have to build something for this, different from what you already have.
So Prashant, it will be a mix. Okay, for us, it is a similarity in terms of these are also contractor influenced products. So it sells through the same channel, and you will see the new generation of plywood distributors and dealers. The new generation, once they have come, they want to make one-stop shop for selling everything under one roof and umbrella. In which case, our existing dealers are so excited about these products. Even if they are not selling, they want to start this as a dealership. So I would see that maybe 50 to 60% maybe a common dealer where we can get in very easily, and then the rest of the hardware channel, which is already there in the system in trade, is where we have to get in. The other advantage, what clearly we get is, like Greenply 3 years, 4 years back was only into plywood. We expanded into MDF, and we are running that successfully in the first year itself. Now we are getting into hardware. So, Greenply, the tagline, which says Har Zarurat Ka Reply, we are also trying to create a one-stop shop that we are able to go to an OEM and are able to give them maximum number of products. Today, see, the transactional cost for everyone is very important. If an OEM has to deal with 10 vendors, their transactional cost is very, very high. We are trying to see that, how we can take many solutions to them, and, we save their time and we save overall transaction cost also.
Mr. Zultan, you said margins can be 25%. What about revenues for you from this business?
See, our ballpark calculation right now, these are estimations which has come from our JV partners. The type of facility what we are talking about, once all the phases are complete, this will give us a capacity on current prices of anything between 750 to 800 crores of top line at 100% capacity.
All right. Hi, Mr. Tulsian. Good speaking to you after a while. Nigel on this side. So basically,
Hi,
this
Nigel.
asset turn is around 3 times, right? The investment. You will put
Yes.
250 crores and at peak you'll get 750 to 800 crores. Got it. So I think we've spoken enough about this business. Tell us about other trends. How's the plywood business doing? What kind of volume growth will you end up with for FY24? And what about FY25 on whatever you deliver in FY24?
So Nigel, a few things I think which is worth mentioning. Greenpla was trying to do a lot of correction internally into the business, and we have been onto that journey. Plywood volumes during this year, we had given a guidance of 8 to 10% volume growth. We are right now on a 8% plus volume growth. And even for the next few years, I have been giving this guidance that, the volume will grow at anything between 8 to 10%. This is purely on the fact and the belief that, whatever internal corrections which we have done in terms of whether our policies or whether our approach to go-to-market strategies, whether our branding strategies and everything, and the team which is there at present will be able to deliver this type of a volume growth. If you ask me that what is the industry growth, truly speaking, we don't have that numbers. We are looking at more as an intrinsic growth principle that there is an opportunity. The plywood market today is anything roughly around 13,000 crores. And we are just around 1,800 to 2,000 crores. So as a leader in the plywood industry, we still have a fair play to improve our volume, And if we get some more support from the government, because the unorganized portion is extremely, extremely high. The GST is today around 18%. And we all understand that the GST collections have picked up like anything. I am believing that, there will be one more level of correction on the GST rates. And if the GST rates are dropped by the government, then possibly the shift from the unorganized to organized will take place.
What is the current GST rate, sir? What is 18%. The current GST? 18%. And you're expecting it to come down to?
Well, we believe that actually it should be 12%, but
that's on your wish list.
Yes, that's a wish list.
Let's see how much of that comes through. The other smaller part of your business.
Complete the point, if that doesn't happen, we are on the growth trajectory. And I think one more important initiative which the government is taking is the Make in India concept. And the BIS, norms which the government wants to strictly implement into this country. Though there is a deferment which has happened by around 10 to 11 months, but these are very good signs, where that low quality or the substandard plywood will no more sell into this country. The moment these type of reform measures keeps happening, you will definitely see that, all the branded goods players are getting the advantage of the same. And we are prepared to get the larger advantage of the same.
Got it. So that's about plywood. What about the MDF business, the newer part of your business, very small as of now, but how do you see that revenue scaling up? What do you end this year with for FY25 and FY26? Because there's big potential out there as well.
So, Nigel, first thing first, again, we commissioned the plant in 15 months. That was a very stringent target which we took, and we faced some challenges, because there was, when we initiated the journey, there were some pandemic hiccups also which were there. But, God has been kind. We were able to do it in 15 months. The ramp up has been very good. This is the first year of operations. We actually started selling from the month of June itself. Our target was somewhere this year to hit a revenue of anything around 350 crores in the first year. And we are very much on that target. In fact, we'll surpass that target. And next year, we are again looking at this whole turnover to grow by at least 50% from here, which means we will be able to use around 85-90% of the capacity in year 2.
Just before we let you go, Mr. Tulsian, all of this expansion plan could perhaps put some pressure on your balance sheet, you think? Your gross debt is about 750 crores. But what are you comfortable taking it up to over the next 1 year?
So, Sonia, a few things. I always believe balance sheet management is very, very important. Before we embarked on this journey of growth, the first thing was that we corrected our balance sheet. And we had a cash of around 250 odd crores, which we used as an opportunity to first invest into the MDF plant and then also a plywood plant expansion. So today, if you really see, we are sitting on our India books a debt of around 500 to 550 crore. There's another 200 odd crore of debt which still reflects on the books, but that is with respect to our international business. And that business we have been able to hive off in terms of giving the majority to another set of investors. So 225 crore of debt will no more reflect after March. So it will not even reflect in the March consolidated numbers. So technically speaking, we are now at around, we'll end the year, or we have ended the year maybe around 525, 550 crore of debt, which is around 0.7, 0.75, debt to equity. Our plan is to further strengthen the debt to equity because, with the margins, profitability going up, the net worth will improve significantly in the next 2 years. And we believe that we will bring down the debt at least by 100 crores in the next 2 years. So I think the debt equity will be extremely, extremely comfortable. At any point of time, we don't want to go beyond 0.5 as debt equity.
Okay. Mr. Tulsian, and that 750 to 800 crores at full capacity, which you said from the new business, that is by when, sir? If you can give us a
the capacity. See, the capacity, Prashant, I think will be on by in the next, I would say maybe 18 to 24 months. Okay. But, this business, it is not so easy to ramp up the business because there are some large players who are sitting there. For us to build up this business, it will take a few years. But, as I said, that the margin profile is extremely good. And the product, the engineering, what we have seen is marvelous. They give a cycle which is even better than some of the other players who are selling into the market, the best names into the country. So we are very, very hopeful that our ramp up will be extremely fast.
All right.
And then we'll grow this business over a period of time.
All right. Wishing you all the best, sir. Thank you very much, Mr. Tulsian, for joining us and talking to us in detail about this new venture and, of course, your existing business on the ply and MDF side as well. Thank you very much. We'll take a break here. We'll come back and we put the focus on the first IPO of F525, Bharti Hexacom. Rima will get us all the details. Stay with us.
Welcome back. Well, Mitesh Thakkar is joining in now to tell us what to do with the market. By the way, this is out and out a buy on dips market. Just look at that. Early morning, we saw a bit of a fall, and now that's picked up quite a bit. In fact, the mid-cap index is in the green. Mitesh, what would you do? Is it confirmed now that the best strategy is to buy this market? And if yes, what are the stocks to look at?
Sonia, the only thing which I have not been doing is buying the index, because the Nifty and the Bank Nifty haven't given a breakout. But rest of it, I think we have had all buy calls. Yesterday we had SGX, which was negative. Today we had GIFT Nifty, which was negative. Today I think similar scenario, and we have been buying. And today I think I did mention to buy on declines on the index. So we have advised our clients to do that. So yes, there is clearly long buys. A move about 22,530, I think will add to a lot of momentum. So I think then we can be slightly more aggressive tactically. But till then, buying the index and the stocks. I have a buy on Steel Authority of India right now. Buy with a stop at 146 for targets of 165. And the other one which I like is JSW Steel. It's giving a pullback, but the overall chart structure is very positive. So keep a stop below 852 here. Look for targets of 915.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's shift focus now to the primary market. Telecom service provider Bharti Hexacom's IPO will open for subscription today. The issue is an offer for sale where the government entity TCIL will sell a part of its stake in the company. Rima is here to tell us more about that. Rima, over to you.
Thanks so much for that. So Bharti Hexacom, the first IPO of FY25 and also the first IPO from the Bharti Group in over a decade. The last one was Bharti Infratel, which is now known as Industars, way back in 2012. So there is considerable excitement. But let's get to the IPO details then. The IPO opens from the 3rd to the 5th of April. The price band has been set at 542 to 570, giving it an implied market capitalization of 28,500 crore at the upper end. Now, this is a pure offer for sale, which means no money will go into the company. Now, who's the selling entity? The selling entity is the Government of India, an entity called TCIL, Telecom Consultants India Limited, which will sell half of their holding. They have 15 crore share. They're planning to sell 7.5 crore share and overall raise about 4,200 crore rupees. Now, Bharti Airtel is the promoter. They have a 70% stake in the company, but they're not planning to sell any stake. Now, about this company. Now, this is your telecom service, telecom company. It provides mobile services, but unlike, say, a Bharti Airtel, Jio, Vodafone Idea, which are pan-India players, Bharti Hexacom operates only in 2 circles in India, Rajasthan and Northeast. Now, in Northeast, the company is a market leader with a market share of more than about 50%, while in Rajasthan, it's the second biggest player with a market share of about 40% as of December of 2023. The company was originally incorporated way back in 1995 as Hexacom India. Then in 2004, its name was changed to Bharti Hexacom Limited, which is when Airtel had acquired a majority stake in the company. Now, this company pays a management fee to Bharti Airtel for common marketing, admin, personnel expenses, and this is approximately about 1.7% of its revenues as of the latest numbers. Now, on to the financials. The company's top line has grown at a CAGR of 12.65%. So revenues now, as of the last year, stand at 6,580 crore. But the big positive has been the margin improvement. And look at the margin trajectory. Margins in FY21 were sub 25%, and they've risen to nearly 50% as of 9 months FY24. And the margins of the company have basically doubled. Yet the bottom line of the company has been fairly volatile on account of exceptional items. The big driver of the margin increase was a price hike, which took place about 2.5 years ago, which led to the ARPU of the company. ARPU's average revenue per user rising from 135 in FY21, 155 in FY22, and now it's nearly touching the 200 rupee mark as of 9 months of FY24. Now, it's a fairly big IPO, but what one needs to remember is that it operates only in 2 circles. So the customer base has not been growing at a very fast clip. Growth for the company is coming from upgrading its existing 2G subscribers to 4G and price hikes. Valuations then, now FY23 EPS of the company was about 11 rupees, which means at the upper end, we're getting a trailing PE of 52 times. So it's cheaper than Bharti Airtel, which on a trailing basis is at about 80 times plus. But remember, Bharti is much, much bigger in size. Bharti Hexacom's top line is about 6,500 crore. For Bharti Airtel, it's 1.4 lakh crore rupees. Back to you.
All right, Rima, thanks a lot for that. Well, let's dip into a quick break. On the other side, we get chatting with Max Layton of Citi to put focus on the commodity market. Stay with us.
Welcome back. And the gold prices are trading at an all-time high, silver at a 26-month highs, copper at 11-month highs, and you have crude oil prices trading at a 5-month highs as well. So what better time to get Max Layton? He's Global Head of Commodities at Citi, and he joins us right now. Max, hi, thank you so much for joining us here at CNBC India. I want to first start with the Chinese data, and that really seems to be improving. The month of Feb was good. March, more or less, has been on the positive side as well. How do you look at these numbers now?
Look, I think it's a continuation of the trend that we've seen over the last year or so, which is that energy transition spend, energy transition investment in China continues to boom. So the renewable power additions in terms of generation capacity were very strong in the first couple of months of this year. And on the other side of the coin, construction activity has continued to soften. So, we've seen iron ore prices pull back 25 to 30% as a reflection of the weakness in construction activity. And we've seen copper prices, grind higher, and we think move into a higher range as a result of the energy transition demand and some supply issues on the copper side. So it's really, I think, a continuation of the theme that we've been seeing for some time now.
Max, I do understand that Citi has been bullish copper for some time, and we've seen all-time highs in China, 11-month highs on LME, 16-month highs in US for copper. How do you see the smelters output cut reaction in China?
Yeah, so I think a lot of people have been getting very bullish on copper, and you know what? We agree. Right, we've actually been quite cautious and often bearish on copper between May 2022 and the end of last year. So for about a year and a half, we were quite bearish or cautious. But we turned to tactically bullish copper, targeting 8,800 and potentially 9K at the end of last year in early December. And, now we're up at 88.9K. We had a big decision to make. Is copper going to pull back on a rising debt service burden, on a weakening global growth outlook over the next 6-12 months? Or is it going to continue to kind of grind higher, with the range shifting up over time due to underlying deficits and supply issues like those that we're seeing in China with the potential smelter cuts in the next couple of days and over the next few months? We decided that it's going to be the latter. We now think that, investors, we're strongly recommending investors have a position in copper, and we're strongly recommending that consumers of copper hedge their exposure over the next 1 to 3 years. It's on a path to 12,000. There's so many different ways to get there over the next 2 years, but that's where it's headed.
All right. So while you're talking about all-time highs in copper in the next couple of years, the ferrous metals clearly have not performed so well. Last year was a negative one. This year until now, the first quarter hasn't done so well as well. So how would you look at the ferrous metals, and do you see this constant pressure continue?
Sure. Yeah. So iron ore and steel, we're getting down to levels closer to cost support. I don't think we're there yet, but so on the iron ore side, down at $100. And towards the end of the year, the backwardation in the curve takes the price down into the 90s. In prior cycles over the last 4 or 5 years, and certainly based on our cost curve work, you normally get support in the $80 to $90 range. So having fallen about 35% over the last few months, you're around 10% or so away from historical lows in cost support. So we're getting there. We're not sure it's the right time to get in right now, but we're really close, and we think we'll get there down to $90 or so over the next month or in the coming weeks. At which point we think it's going to be a fantastic buying opportunity on the iron ore side. Steel, I think we're more neutral. Range bound market's been range bound for a very long time. We're not really expecting that to change.
I want to come back to the non-ferrous metals, and here the aluminum prices are trading at a 3-month highs. Nickel has been under pressure. Tin continues to take its cues from whatever news comes out of Indonesia. So barring copper, which you are very bullish on, what is your sense on the rest of these non-ferrous metals?
Yeah, I got to say copper's the one that we like. The other ones are underperforming, in part because they're just not attracting the same excitement as copper. So the relative positioning from investors is weighted towards copper. So whenever people think that the world might start to, the Fed might start cutting rates and we might have a turn in the manufacturing cycle, the chosen way to express that view is copper. And it's not the others in copper. So copper positioning's maybe 6 or 7 out of 10 on the last 5-year range, whereas all the other metals are around 1 or 2 out of 10. Our least preferred metal, so we're most bearish on nickel. We published our quarterly outlook, our slide deck about a week and a half ago, and in that we said that investors and producers should sell nickel at around $18,000. It's come down to around 16,500 at the moment. We think there's more to go. It's going to come down to around 15.5 over the next few months, and that's where we kind of expect it to settle. This market is burdened by substantial supply growth, particularly led by Indonesia, and so we think it's the big underperformer. Aluminium, hey, look, we're medium-term bullish on it, and eventually it's going to have its time in the sun. We're just not expecting it anytime soon. Broadly balanced market. People are not really truly believing in a global recovery en masse, so they're not willing to put on the aluminium leg. They'll put on the fear of missing out trade in copper, but they won't put it on in aluminium, I don't think. But eventually, when global growth does turn, let's call it 18 to 24 months time, there's practically no supply growth in that commodity, and aluminium's gonna have a good run. We think it'll get up to, on a 2-year view, we've got it coming up to 2,900, which is some pretty substantial percentage upside from 2,300. And zinc, largely neutral, trading the range. We're just getting tactically bullish down at 2,300 and getting tactically bearish up at 2,600. And, we'll kind of expect that to be the story of the next couple of years in zinc.
And Max, I do want to talk about the gold prices. All-time highs every single day for last 10 trading sessions. Now we are almost inching to that $2,300 per ounce mark, forgive me. And silver has been surging as well. How do you look at the precious metals from here on?
Yeah, we're loving it too. We're on the bandwagon with gold. I think you only have to go back to the second half of 2007 and look at that Fed cutting cycle when it cut from 5 to 2%. And how gold and silver performed during that period. And we're expecting something of a rerun of that over the next 6 to 12 months. So we've got gold hitting new, fresh, all-time highs, 2,300 an ounce. And we've got silver, even on a 6-12 month view, outperforming gold. Silver doesn't just have the Fed cutting cycle on its side. Silver's also got very strong demand from solar and from EVs coming, led by China, but also globally. So we've got silver getting up to $30 an ounce over the next 6 to 12 months. So certainly we would recommend, dip buying over the next month or two as the market digests this really big inflow of funds into precious metals over the last couple of weeks.
And Max, there's a lot of action in energy as well, especially with the conflict widening now in Middle East, with more countries getting involved, and the crude oil prices are now trading at a 5-month highs. I remember you saying that it's going to be difficult to be bearish in crude. And what is your sense then for prices from here on for the rest of 2024?
Yeah, I think one of the most popular trades or views in the oil market is being bearish volatility or being short vol. And this is a reflection of the lack of fundamental deficits or surpluses, the material deficits or surpluses that people see over the coming quarter. So essentially, people are generally not expecting much to happen, and we're in agreement with that. We think prices are going to be pretty neutral at around the $80 mark over the next 3 months on the Brent side. We think it's a very difficult market to be bearish because of the fact that the situations that you mentioned, and obviously with President Netanyahu saying that he will intends to go into Rafah, that suggests that there is a room for material escalation and tension over the coming months, right? So very difficult to be bearish, even if you do have a surplus like we do in our balances in the second quarter. But looking further out, maybe not for the second half, but certainly into 2025, you've got these big structural stories in crude oil. You've got weaker demand growth coming from the cycle, from the global cycle. You've got higher efficiency in terms of automotive use of oil. You've got EVs taking massive market share in China, which is reducing Chinese demand growth. And you've got very broad-based, strong supply growth, especially as prices trade at $80 plus over the next 3 months or so. You know, you're going to have very broad-based non-OPEC supply growth over the next 12 to 24 months. So 2025, we're very bearish, actually. We think the vast bulk of scenarios point to lower prices in 2025, and we have an average price forecast of $60 in 2025.
All right, that's an ouch for the producing countries. But when you talk about 2025, Max, would a lot depend on where the dollar index is, what the US Fed has done until then in sense of rate cuts, with European central banks also talking about rate cuts. How are you approaching the second half of this year?
I mean, I'd say a standout dollar view is we've got dollar-euro going to parity in the second half. When I say we, I mean Citi as a house. And that's essentially on the basis that US kind of outperforms Europe essentially on the growth side, and therefore and on the inflation side, and therefore policymakers cut rates during the second half at a faster pace in the Eurozone than they do in the US. And so that's probably our standout view. I don't think that's going to be a big headwind at all to precious metals, although it does, you know, it takes out some of the upside.
All right. Max, a final question, and this one is on agri-commodities. And while everything else seems to be consolidating, it is cocoa which is on fire, up 125% alone in this year itself.
Yeah, cocoa's on fire. You know, amazing move in that market. It just shows you what commodities can do when you get inventories down to critically low levels. And yeah, I mean, it reminds me of 2003 in copper when you ran out and the price went up 5 times. Similar things happening in cocoa. Look, you know, my colleague Akash does some great work on ags, and he's been bullish most of the way up. He's staying bullish in the short run. But I think we're more looking on, you know, on the cocoa side, we're more looking when to get out at this point, because I think there's going to be a lot of opportunity for investors on the way down. You know, calling the top's very difficult, but, you know, we think we're close to a turn at some point in the next couple of months.
All right. Max, thank you so much for talking to us at CNBC-TV18. It's a pleasure as always. So that's the view coming in from Citi. Going forward, it's all-time highs for gold and copper. Silver can outperform gold is what Citi says. And when it comes to cocoa, well, selling perhaps is the best strategy from here on. But that's all the time that we have on Bazaar. Chartbusters is up next.